For more on the latest property news, joining me now is Domain's Chief of Research and Economics, Nicola Powell. Nicola, thanks so much for your time this evening. As we've just heard, many landlords are selling their investment properties, but new data also shows that parts of Queensland and New South Wales have seen a jump in distress listings compared to this time last year. Just how much of an increase have we seen in those urgent sales?
We have seen on that broad scale across the capital city, they do remain very contained and they've actually declined compared to this time last year. But what I would describe is there's certain areas where we are seeing an increase in distress listing. As you mentioned, it is in some suburbs of Queensland and also in New South Wales. And the way I would describe it, it's across that mortgage belt where people have perhaps stretched themselves financially to gain access to that particular suburb. And obviously with the high cost of now holding a mortgage and the fact that the cash rate has stayed higher for longer, I think is weighing in on some households, and particularly in the backdrop in a cost of living crisis. When you have a look at Sunnybank in Brisbane as an example, around 2 in 10 listings are actually distressed, and Gold Coast North about 1 in 10. And if we look at Blacktown, Parramatta, Fairfield in New South Wales, again, there's about 1 in 10 listings that are distressed.
What impact, if any, do urgent listings have on the market as a whole?
I think when you see an elevated level of distress listings on that broad scale, it can obviously have a negative impact on price. I think overall, though, we do see that distress listings remain very contained on that capital city level. All of our capital cities, around that kind of 2% mark in terms of level of distress listings. And really to have that negative impact on price, you really need to see a broad-based uplift of distress listings. And that just isn't happening. There's certain pockets it is happening. And I think as well, we have to remember we've seen a fully recovered housing market. So those people who do need to offload their homes quickly, they're likely to be able to clear their debt because we've got house prices rising and fully recovered housing market across many of our cities.
Yeah, so even though usually when you see urgent sales, distress sales, you usually think that you may get a better price on that home because they're willing to go lower, but that's not the case, is it? We're still seeing those high market prices.
I think so. I think we have to remember market dynamics do come into play here, and we have seen our housing markets continue to rise in terms of property prices. And what that means is, if you are in the situation where you need to sell your property quickly, you're likely to be able to get enough to actually clear the debt because we've seen prices rise. The RBA actually estimated about 1% of homes are in negative equity. They're the ones that we need to be worried about. But the thing is, we've got rising prices, so that proportion of homes that are in negative equity will be reducing over time.
Now, looking at rents, the latest rent data from Domain indicates that renters are finally seeing a bit of relief. What areas have seen that most relief?
It has been quite interesting, and this is actually quite broad-based across Australia. We've seen rents either stabilise, so they're flatlined over the quarter. They're increasing, but they're increasing at a lower pace compared to what we were recording, or they're actually now declining. When we have a look across our combined capitals, rents are now rising 1.5 times slower compared to the previous quarter, and unit rents rising half as fast as the previous quarter. It's slightly different depending upon the dynamics, but I think this is such a change compared to what we had been experiencing. And particularly when you look to markets like Sydney and Perth, we saw house rents flatline over the quarter. So I think this is a big change. And while it's certainly going to take some movement in terms of rebalancing the rental market, I think this is showing that it is certainly moving in the right direction now.
So are we expecting a trajectory to continue in this direction with those rental prices to either stabilise or potentially continue to drop in some areas?
I think it is quite interesting because it is still a landlord's market technically across Australia, which means we've got vacancy rates below 2%. I think what we're expecting is the rental market is going to continue to rebalance between supply and demand. And there's many metrics that showcase that to us. We've seen a substantial drop in the number of potential renters per rental listing. And I think that really showcases a better balance between supply and demand. I think we've certainly still got some way to go. And I think particularly in the rental market, market, I think what we've seen is tenants have just reached that affordability ceiling. And what that means and how that plays out in the rental market is people relocate to a cheaper suburb, they go back into a house share, or they move in with family members in order to cost cut. And I think we've seen that play out quite dramatically across the rental space. I think there's also, in some pockets, we are seeing investors slowly come back in. And I think over time, the reduction in demand, because we've passed the peak in population growth, and higher levels of investment activity are going to see the rental market reach that rebalance.
All right, Nicola Powell, thank you so much for your analysis this evening.
Thank you.